Good morning. Welcome back to UT. I appreciate being invited to speak with you today. The first thing that comes to mind is anyone who moved to the back because of the videotaping who is thinking, well, my lawyer said I shouldn't be videotaped. I'd love to see you after. Anyway, I find it really interesting how people remember certain things fondly, after time passes. And the thing I would remind you is, and I hate to burst your bubble, but it wasn't really the classes that made UT so fun. So, I think the fact that you're coming back and you're going to be in class for 2 or 3 days, that wasn't the great part of school. I often wonder if I'm going to at some point look back and think about that day when I had a kidney stone and think, wow, that was awesome. I want to do that again. But in order to make you feel like you're in school, I've got a 2-hour lecture that I'm going to pack into 1 hour, and that's pretty much what we do most of the time in school. So what I'm going to talk about today is who is to blame for the subprime crisis, and that's the lawyer in me. Someone has to be to blame, and I think that there is no question there are plenty of people to blame. And I would say, make no mistake, because we're in a terrible position right now. GDP has contracted at 6% for the last 2 consecutive quarters. It was the worst 6-month performance in 50 years. It's the first time since the 1970s that we've had 3 consecutive quarters of shrinkage in the economy. The unemployment rate is at 9.4%. We're headed to over 10%. If you include discouraged workers and workers who have accepted part-time work even though they want full-time work, that number is 16%. That's 1 in 6. I mean, that's amazing, right? Chrysler and GM have filed for bankruptcy. The government is running Fannie Mae, Freddie Mac, AIG. If you, 2 years ago, put together a portfolio of blue-chip financial securities, Fannie Mae, Freddie Mac, AIG, Wachovia, Washington Mutual, Lehman, Bear Stearns, Merrill Lynch, Bank of America, Citi, you've lost over 80% of your money. I heard the situation best described by an economist. And what he said was, what we're going through right now is worse than going through a divorce. He said, I've lost half my assets and I still have my wife. I will tell you this, that joke was pre-approved by my wife. The faculty can have all the degrees we want, but the true sign of intelligence is when you know who to be afraid of. And trust me, I know. So let me start. Before I get into the who's to blame, hopefully you have my outline that I gave you. I'm going to use this outline rather than using slides. But in this, I'm going to take you through a lot of the different parties that people talk about. And I'm going to read out the different parties right now, and then I'm going to go back and I'm going to ask you to vote. And my question is going to be, if you could say that there's one of these parties that is the most culpable, the most guilty for the situation we're in, who would you say it is? And your choices are going to be the Fed, home buyers, mortgage brokers, home appraisers, mortgage insurers, banks and bankers, the SEC, the rating agencies, bond insurers, investors, or SIVs, structured investment vehicles. So let me go ahead and go through this. So everyone, you select one that you see. And I've done this several times, and there are plenty of good choices. I think they're probably all good choices. How many of you would vote for the Fed? Would blame the Fed? Fair number. How about home buyers? Home buyers, a few people. Mortgage brokers, a few. How about home appraisers? 1, 2, 3 people. Mortgage insurers, just 1 or 2. Banks and bankers, fair number. The SEC, just a couple. The rating agencies, a couple. All right, bond insurers? No one. Investors? No one. Structured investment vehicles, usually one or two people. All right. Yeah, you know, the politicians. I think that people always ask that, and I think that's a fair comment. I think the politicians certainly are, have their share of the blame also. Let me go ahead and take you through some of the arguments, and you're going to notice in the outline, just because of time, I'm going to skip some of this, but I'm going to try to go through the majority of it. So let's start with the Fed. Now, a lot of people blame the Fed for several reasons. The first being that they lowered interest rates to 1%, and people say, that encouraged speculation, and what that they say that resulted in these low mortgage rates that resulted in everyone trying to buy a house. And I think it goes a little bit deeper than that. The low interest rates, what happened was that people could buy treasuries and they had a very low yield. And there are all these fixed income investors who wanted a higher rate of return than 2.5%. And so, what's the solution? Well, what we could do is we could package together some mortgages and we could pay you interest based on the mortgage payments. And with those mortgage-backed securities, that will give you a higher rate of return. But we've been doing that for years. Well, what if we packed together some mortgages that paid really high interest rates? Then we could really pay you on this bond or this mortgage-backed security, we could pay you a really high interest rate. Well, how do we do that? Well, we need all these mortgages that have really high interest rates attached to them, thus subprime, right? We have this demand for these subprime mortgages. So the low interest rates led to demand for this. And the Fed saw things that made it apparent that there was this growing demand for these subprime mortgages and what's known as Alt-A. And just sort of the quick review for those of you not familiar with it, you've got prime mortgages, which are generally defined as people with a FICO score of 680 and higher. You've got subprime, which is 620 and lower. And then in the middle, you've got what's known as Alt-A, which is sort of 620 to 680, and it's also people who don't document their income and that sort of thing. So you have these three categories. Well, we saw subprime loans. There were about 1 million issued back in 2003. Well, there were about 1.5 million in 2006. So we had this large growth, but it was more than just the growth. Realized that the dollar value of each mortgage was higher because home prices were appreciating. So we saw this huge explosion. We saw other interesting things where the Fed did, where you would think with all of the issuance of these subprime mortgages that the spread between a prime mortgage and a subprime would really have gotten large, but instead it shrank, right? So that ultimately it was very different. We saw that there was this huge demand and people were overpaying, which meant that this spread was small. So we saw a lot of different things like that. People blame Greenspan because he didn't want to regulate derivatives. He said, derivatives are a great way to shift risk. It turned out it shifted risk from companies to us as taxpayers. He made comments about adjustable rate mortgages that I think was somewhat misinterpreted, where he said, look, if you take the last 25 years, home buyers would have been much better off borrowing money using an adjustable rate mortgage. And he was just making an empirical statement saying that, look, rates have come down, so you would have been better off with that adjustable rate as opposed to paying a fixed rate, which you're paying a premium there for that insurance, knowing that the rate's not going to change. And that, of course, led to more people. It was reported in the USA Today, Greenspan says you're an idiot if you didn't get an adjustable rate mortgage, right? And that kind of thing, I think, got misinterpreted sometimes. We saw other things. Bernanke let both creditors and shareholders get wiped out in certain transactions. Personally, I have no problem with shareholders getting wiped out. I think that's the way it's supposed to work in the capital structure. But the problem was, as we let some of these parties get wiped out, it became very, very difficult to raise capital again. So that was a problem. We saw other problems, and I'll lump in the Treasury with the Fed. And the Treasury came out with these plans, or the rumors started that they were going to be buying some of the assets from these banks. Well, that slowed down the whole let's fix it process. Because think about this. If you have a house, right, that you bought for $400,000, and now it's worth $200,000, and you should just get rid of it, because you don't need that second house or whatever it is. Well, you're not going to sell it if you think the government's going to buy it from you for $300,000. And it's the same thing with the banks. The banks had these assets that they knew were worth very little, but they were hoping that the government was going to buy it for more. So we saw a lot of that. You know, the Fed, I don't know. I think there's plenty of blame to go around. I don't think any of these choices are bad choices that I've given you as to who to blame. My view on the Fed is that the Fed deals with the fire that's in front of them right now. And if you look back to 2000, 2001, markets dropping after the tech bubble, we've got 9/11, we're in a recession. If the Fed wasn't lowering rates, we would have been hollering and screaming back then. But plenty of blame to go around. Let me talk about home buyers. Home buyers, a lot of home buyers were just purely speculators. And I should say, when I talk about all these groups, whether it's home buyers, mortgage brokers, bankers, you know, what you're going to find is that, you know, it's some, it's not all. It's no different than there are good teachers and bad teachers. There are people who did the wrong thing and there are people who did the right thing. I'm here talking about the people who caused the problems and did the wrong things. But some of these home buyers were just purely speculators, right? One of the interesting things we find in markets is that if you show people a rising market, you know, think about stocks. Stock market's going up and you say to people, what do you think your average rate of return is going to be over the next 10 years? They'll say a really high number. The market goes down and you ask people the same thing and they'll say a really low number. In reality, it's the exact opposite, right? When you buy when things have gone down, then your rate of return is going to be high. When you buy when things have gone up, your rate of return is going to be low. People are trend followers. And of course, you know, we were at this time that home prices were going up, stock prices were going down. So what do people do? They look at buying homes, and they're buying expensive homes. A lot of these people were buying investment properties, second homes. If you look at the mortgages originated in 2006, 16% of them were for investment properties. 16%, right? I mean, 1 in 6 mortgages is for a second home. You know, we don't need second homes. And, you know, certainly 16% of homes shouldn't be second homes. And, you know, I always say you have to be careful with averages. You know, I always tell my students that, you know, you put your head in the oven and your feet in an ice bucket, and on average, you're comfortable, right? But you know, there are always these extremities, and they might not be that comfortable. And when we have this 16% average, what we have is 30% of homes in Nevada, Florida, California, and Arizona were investment properties. And of course, they had the most problems. I mean, 30%. Yeah. So that was one problem. And also one thing is a lot of these people were buying these properties with speculative loans, which we're going to talk about in just a few minutes. Some of these people just weren't financially savvy. They didn't understand the terms of the loan. They didn't understand the effects of leverage. They didn't understand that the run-up in home prices was not sustainable. Some of these people were just committing fraud. You know, some of these loans, no documentation loans, well, what happened was one study showed that in 60% of these no documentation loans where I don't document my income, I'll talk more about that in a little while, 60% of them, the people had overstated their income by 50%. Right? That's a little bit of a miss. Right? So, and of course, you know, we could argue about whether it was the person or whether it was the mortgage broker. Sometimes both. You know, who knows? Some of these people were involved in criminal conspiracies, and here's how this works. I buy a house for $200,000. I get a $180,000 mortgage. I list the house for $300,000. You're working with me. You come and you buy it for $300,000. We get it appraised for $300,000. You get a $270,000 mortgage. We use that to pay off the $180,000. We've got $90,000 left that we can split. All right? And you know, a lot of you are probably thinking, "Wow, school's gotten a lot better. They teach us how to do criminal conspiracies." So, if you remember nothing else, then that's probably what you'll go home and tell people. You know, one of the other problems we had was that we were just digging too deep into the pool of home buyers, and that's politically incorrect to say, but it's true. If you look at the home ownership rates in this country from 1960 to 1990, it was up and down, but from 1960 to 1990, we went from 62% to 64% home ownership. When then, in just 10 years, 1990 to 2000, we increased another 2%, from 64 to 66%. Then, in another 5 years, we went from 66 to 69%, another 3%, right? We were just digging too deep into the well of home buyers. Not everyone is financially able to buy a house, and that's unfortunate, but it's a reality, and we're seeing that number come right back down now, and we're headed lower. You know, a lot of these people were the subprime borrowers. A lot of these, one of the things you see is that typically people default on their mortgage. Historically, we'd see people default on their mortgage after 3 years, you know, probably is a good average. We started seeing people default right away. We saw some situations where people didn't make their first payment. And so, you know, that's what was going on, and it's a sign of the type of loans that were being made. Another issue with the home buyers was that homeowners were over-leveraged. And I always define or describe home buying as the poor man or the common man's LBO. It's a leveraged buyout, right? What happens in a leveraged buyout? A firm goes and buys a company, and they borrow all the money. And you know, think about that. If I put $3,000 down and buy a $100,000 house, if that house goes up to $103,000, it's not as if I just made 3%. Right? I took $3,000 and turned it into $6,000. And so that's what people are doing, right? They're using other people's money, and ultimately you get great returns if prices go up, and they did for quite some time. You know, talk about leverage. I'm going to give you a sort of a strange example, but there's a lot to this. This is pretty wordy, but if you think about mortgages, there are two types of mortgages. Some mortgages are used to purchase a home, and some are to refinance. So that's the two types. Now, I'm going to just talk about the purchase originations right now. So mortgages to purchase a home. And we can look at, let's say, a $100,000 house, and let's say you get an $80,000 mortgage. We would say that the loan to value is 80%. You borrowed 80% of the value of the house. But there's another statistic, and it's called the combined loan to value. And that includes not just that first mortgage, but any piggyback loan that you might have. If you look at subprime purchase mortgages, purchase originations, during 2005, 2006, 2007, and you say, let's look at those subprime purchase originations and the combined loan to value. So what percent of the value of the house were people borrowing when you add in all the loans? And we say, let's look at the median person. So if you lined up all the people, not an average, but you lined up all the people, you said right in the middle, that person in the middle, what percent did they borrow as a percentage of the value of their home when you combine all their loans? What do you think it was? Yeah, 90, 95. It was 100. It was 100. And you might think, wait a second, how can you have 100? Well, it's the median. That just means that at least half the people borrowed the full 100%, no money down. And, you know, you've got to realize, one of the things that I always thought about that was just so strange was that, you know, when you have this and you have people who walk away from loans and their homes, you know, why would someone do that? I remember when I started hearing about this, people mailing in the keys, I thought, how does that happen? You know, if I mail in the keys, people are going to sue me and get my other assets. And, you know, that was when I realized in most states, these loans are non-recourse, meaning you can't sue someone for their other assets. And so what this is, home ownership, it's not only this leveraged buyout, but it's like a call option where I get the upside. If it goes up, I win. If it goes down, I don't exercise my option. I just mail in the keys. It's a pretty nice deal. So, you know, you could imagine why people are doing it. The average home buyer put less than 20% down. They're borrowing a greater percentage of their house. Home prices are increasing and inflated, and a lot of them are paying interest only on their loans. They're not amortizing or reducing the principal of their mortgage. And you know, you have to realize that, again, some of these people are just good people who are trying to put their family in a home when home prices are increasing. They can't afford an amortizing loan. But a lot of people are just playing the system and knowing I can walk away if it doesn't work. Next issue with the home buyers is a lot of people were refinancing and extracting cash. So 50% of subprime loans from 2001 to 2006 were refinancings with cash out. So here's what happens there. Buy a $200,000 house, $180,000 mortgage, home goes up to $250,000. What I do is I refinance. And it's not just to get a lower rate, but what happens is now in that $250,000, I'm going to borrow $220,000. I take that $220,000, we pay back the $180,000, I've got $40,000 left. I go to Best Buy, buy my big flat screen television because I deserve it. And of course, I can't really fit it in my car, so I stop and I get an SUV, right? And I mean, that's what was pumping up our economy for quite some time. And of course, that's done. So, not only did it help the economy, of course, the downside was it increased risk. You're staying fully margined. That works fine if home prices continue up on that steady course. But if they don't, the game's over, right? If you always stay fully leveraged, at some point when prices go down, you're going to be underwater. And now we see in this last quarter about 20% of homeowners are underwater. They owe more than their house is worth. And of course, that eventually leads to defaults. One of the interesting things is that if you look at the FICO scores of home buyers from 2001 up to 2006, some studies have shown that the borrower really did not become any lesser quality. And part of that has to do with the fact that, as we'll see in a moment, we were putting some people in subprime loans that didn't really belong there and they had higher FICO scores. But the fact is that you could probably argue that none of these people should have been in homes, or there's a good percentage of people even back in 2001, 2002 that shouldn't have been in homes, but they were all saved by rising home prices. And then the people who bought last, they were no lesser quality as far as credit standards. They were just too late to the game. So let's move on to mortgage brokers. And I think the arguments against mortgage brokers, and I'll tell you my problem with mortgage brokers that's not listed there, is that mortgage brokers were the people who looked the borrower in the eye and loaned them the money. And I would argue that if you're a mortgage broker, to some extent you have a good idea of who's going to be able to make their payments and who's not. Now, the mortgage brokers will tell you, and rightfully so, that they're trying to help these people, trying to help put them in a house, that type of thing. But I think there are plenty of mortgage brokers who will see did things just for their own profit. And my problem with that is an ethical one. I think that when you start saying, look, I can make an extra $2,000 or $3,000 by putting this person in this loan, or putting them in a loan with worse terms, as we saw, I think that's really problematic. And I think it's really problematic when you realize that there's a huge social cost that goes with foreclosure. Kids have to move often to different school districts. They move out of their house into an apartment. Certainly, divorce and marital strife increases with that type of turmoil. And so there's a huge cost when we just try to say, look, I'm going to enrich myself. That's one of the problems I have there. But mortgage brokers were compensated on loan originations. And they were not compensated based on, did someone continue to make their payments? Did you end up making a good loan? That didn't matter. And the reason is that these loans were being securitized. The mortgage broker and the bank make the loan, but then they sell them. They package them into a security. They sell them. If it defaults, it's not my problem. And so right there, you've got a big, big issue. When you've got people who are loaning money and they're not holding the loan, then what do they care? You're lying about your income? Who cares? It's not going to be. You're not going to default to me, so that's fine. Right? We saw mortgage brokers were compensated more for subprime loans. Earlier I described prime, alt-A, subprime, and I understood that to be different FICO scores, your credit score. But what I learned was that that's one definition. And another definition of subprime loan is just simply high interest rate loan. And you might think, well, that sounds sort of like the same thing, right? If you've got a lower credit score, you should have a higher interest rate. Well, the reality is that there were lots of prime borrowers who were put in subprime loans. And you think, well, why is that? I mean, I think two things. One is that the mortgage brokers were paid more to put someone in a subprime loan. Why? Because that subprime loan has a higher interest rate, meaning it's worth more when we securitize it because we can put together a bond that pays even higher interest rates if we have mortgages that have higher interest rates. So you've got one issue is you've got the mortgage workers who have a financial incentive to put you in a subprime loan. The other issue is that people aren't educated. People don't realize that you might think, who gets into a subprime loan when they've got a good FICO score? Plenty of people. The type of one of the things I always tell our students is that our students have very high. I teach the MBA, so they have the GMAT scores, and they have very high scores. They're not used to dealing with the rest of the world, and they're used to dealing with each other, much like most of you are, right? You associate with other highly intelligent people, but that's not the way the world is, and so there are a lot of people who get put into these loans. Again, we saw this tremendous increase in subprime borrowing, and we saw this huge shift. And some of it was because you had these prime borrowers who were in there. But you go to 2006, of all mortgages outstanding by that point, 12% of mortgages outstanding were subprime mortgages. But the mortgages originated in 2006, 20% were. In other words, we had this huge shift. Everyone who was a prime borrower had already bought a house, but now we were just originating to subprime borrowers. That was a problem. The mortgage brokers rolled out mortgages that were destined to fail. I'll take you through a few types. Interest-only loans, right? So you're only paying the interest, and so the result is that the loan is not amortizing. In other words, you're never reducing the principal. Again, that's fine as long as interest rates as long as home prices stay the same or go up. But once the home price goes down and you've borrowed close to 100%, you're underwater. Then there's low or no documentation loans, also referred to as liar's loans. Right? That's me. I go in and ask for a loan, and they say, well, how much do you make? And I say, roughly $2 million a year. And they say, that's great. That's great, Mr. Leeds. Can you document that? And I say, yeah, no. And they say, no problem. No problem. We'll just do a low documentation loan or no documentation loan. The question is, who says, hey, I'm going to loan money to someone and I'm not going to document their income or their net worth or anything else? Who does that? Well, I'll tell you who does that. Someone who's not lending their own money. Someone who's originating a mortgage that's going to be securitized and it's not their problem. So, this represented 16% of all loans originated in 2006. It's a shock we're having problems now, right? And it represented about 38% of subprime mortgages. Then you had these teaser loans. Often they were 228 loans, where what you have is this low rate for 2 years, this teaser rate, and then it increases for the remaining 28 years. So maybe you're paying 1.5% for the first 2 years. Well, if you're paying 1.5% and the true rate is 5%, then it's not only are you not amortizing your loan, you have what's known as negative amortization. And that's fancy finance speak that says your loan's getting bigger, right? And so, because you're not even paying off the interest. And so then when that eventually resets, you've got a problem because your loan has become bigger, your interest rate has gone up. We saw people whose payments doubled as a result of this. But people were being qualified for a loan based on this teaser rate. Just crazy, crazy stuff. We saw what was known as option arms. Option arms basically say you can decide how much you want to pay, right? That's a great deal. And there's some limit. At one point, once most loans, once they get up to about 115% of the original value, then you've got to start making payments. But of course, at that point, people were often walking away. If you look at 2007 originations that were option arms, after 4 months, 60% had a larger balance. So people weren't making a full payment. After 8 months, 90% had a larger balance. Then you had ninja loans. Ninja loans. No income, no job, no assets. We used to have a different name for these. We used to refer to them as student loans. course, the difference is you can't walk away from a student loan. You can walk away from a ninja loan. In other words, you can default on these. I mean, again, who loans money this way? People who aren't loaning their own money. I'd be happy to loan your money this way, right? I'm just not loaning my own money that way. Then you had piggyback loans. We saw that from 2003 to 2006. In 2003, about 7% of subprime borrowers had a piggyback loan, a second loan. By 2006, about 28% of subprime had a piggyback loan. You had stretch loans where you had more than 50% of your gross income was needed for payments. We saw this tremendous increase in adjustable rate mortgages, where virtually all subprime mortgages were adjustable rate. And what's happening here is people are trying to keep their payments low. And so they need that adjustable rate, even though they're taking a risk. In finance, we often talk about signaling theory, where we watch what people do or what management does, and rather than what they say, we watch what they do, and we see that it sends us some kind of signal, and we try to understand what that is. Well, this huge increase in adjustable rate mortgages was a signal. It was that people can't afford these homes, they're trying to keep their payment low, and they're riskier. And you might think, well, what happens when rates go up? Well, when rates go up, you can walk away because they're non-recourse, or in the first part of this decade, you could sell the house for more. But of course that ended, so now you're just left with walking away. Again, one of the interesting things we see with all these loans, though, is that if you look at loans originated in 2006, all types of loans, whether they were fixed rate, variable rate, if you documented or didn't document, all of them saw increases in their default rates in 2007 and 2008. And the point is that these loans were bad, some of the borrowers were bad, but the real problem was that everyone was just speculating, counting on home prices to continue up. Once home prices stopped going up, the whole game was over. A lot of these loans that were made by mortgage brokers could be defined or classified as predatory. They had excessive fees. We saw loans being repackaged every few months with more fees. And the biggest issue, I think, or the most common issue of what I consider to be predatory loans are you're making loans to people who can't pay them back, and that's predatory. But the thing is, we could argue about this, but I don't really understand the argument when we're not documenting anything. We have no idea if someone can pay back a loan. So that per se, to me, is predatory. I mean, you're taking such a large risk and putting it on someone else. So that was a problem. Obviously the mortgage brokers and the people that they were selling the mortgages to didn't properly assess or value risk, and they didn't care because they're not holding the mortgages. One of the things that I find most troubling with the mortgage brokers and the mortgage originators that they worked for was the prepayment penalties. And for those of you not familiar, prepayment penalty says this: if you pay back your mortgage early, you're going to have to pay $5,000 or $10,000 or a few months' payments. There's going to be this extra fee. And the reason behind prepayment penalties is that when these mortgages go and they're securitized, what happens is if you pay back early, which people often do when interest rates go down because they're refinancing, well, if you pay back early, then that bondholder is getting their money back early. And they don't want their money back early. So this is really designed to compensate them for that. And also the idea is, look, this is what allows you to get a little lower interest rate. That's the argument. And I think that all sounds fine. But there's a problem with that argument. If you look at prime borrowers, I would bet that virtually no one in this room has a prepayment penalty on their mortgage. Right? If you're a prime borrower, you don't have a prepayment penalty. Whereas about 75% of subprime borrowers have prepayment penalties. Well, I would argue that you as a prime borrower are actually more likely to refi than a subprime borrower, because most likely you're going to be more educated on average than the subprime borrower, and you're going to realize when rates are low and you're going to refinance. So that whole argument falls out. Right? I mean, why is it that we put prepayment penalties on subprime and not prime? And I'll tell you why. Because we could, right? We have a long history of doing wrong to the least educated, and that's what we're doing. And I think that's a very troubling problem that you can't really get around. Other arguments about the mortgage brokers, they were probably less qualified, and they were in an intensely competitive environment. If you look back in, say, 1997, you had about 50,000 mortgage brokers. You go to May 2007, you had about 136,000. And so, all mortgages were being originated by these mortgage brokers. It was a huge shift where, back in 1987, about 20% of mortgages were originated by mortgage brokers. You go to 2003, it was about 63%, and it kept going up. And so it's hard to argue that as we brought more and more people, we had people who were less qualified in there. A lot of the mortgage brokerage firms were small, they were undercapitalized, and why that matters is that when they take these mortgages and they sell them to the investment bank who's going to securitize them, they say, look, if we made bad mortgages, if they default within 3 months, we'll buy them back. Well, the reality is they didn't have the capital to buy back all these mortgages. So that was a problem. And of course, some of these just committed fraud. Some of them encouraged false applications, did false applications themselves. So lots of arguments against the mortgage brokers. We move on to a few others. Home appraisers. Home appraisers bought into the speculative market. The reality to me is that appraisers said what they were paid to say. And if they started clogging up the system and saying, no, this house isn't worth that, they would have been out of business. And you can argue that would have been the right thing to do. I think that they're a small piece in this whole puzzle. Mortgage insurers, where if you put less than 20% down, you had to get mortgage insurance, and these were the suppliers of that, they made it easy to buy with less than 20% down. The interesting thing, though, to me about this is that these were people who were risking their own capital. And so, to some extent, you could argue that this is a defense to this whole issue for everyone to say, look, you have the mortgage insurers who were risking their own capital because they didn't see this happening. How were we supposed to see it happening? And so the fact that they were risking their own capital, I don't blame them as a result of that. Then you've got the banks and the bankers. They created a lot of these securities, like the collateralized mortgage obligations, the collateralized debt obligations, where what was happening was just sort of the simple version is you put all these mortgages in a pool, and we sell securities that work like this. There's going to be this bottom, what we call a tranche or a slice. This bottom slice where you can buy a security that's going to have, say, a single B rating. And they'll absorb the first defaults, say the first 3% of defaults. They're going to be the first ones to lose. And if they're the only ones who lose, the other bondholders are fine. And then you've got another, say, 3% that's double B, and another 3% that's triple B rated. And then what you find is that a lot of these had, 80% had triple A ratings. And so you took these really high-risk mortgages and you turned them into triple A rated securities, because those triple A rated securities wouldn't get hit or hurt until there was 20% defaults. And a lot of them are going to still pay off, and a lot of them are fine. It's just we just really don't know. So they created a lot of these securities. They marketed them as low risk, high yields. We've seen lots of stories of school districts that bought these securities, that type of thing. What you have is you've got this problem where the banks and the bankers, the compensation is so high. I've talked to bankers who were creating these, and they said, look, the amount of money we were making was unbelievable, and if you started to question this, it was all over. And the compensation made the incentives distorted, and it created huge problems. They passed on information to credit rating agencies that turned out to be wrong. They relied and put too much emphasis on FICO scores that really tells us how much debt does someone have and what is their bill paying regularity. Do they pay on time? And they didn't really distinguish between down payment amounts. And we can use our common sense. And if you have two different people, you have a subprime borrower who puts 40% down, and you put a prime borrower who puts 0 down. the risk is going to be greater with that 0% down. Because you each buy a $100,000 house for simple numbers. The house goes down to $75,000. That prime borrower has negative equity, right? He's just going to walk away. The subprime borrower, he's unhappy, but he put $40,000 down. He's still going to sell the house for $75,000, pay off the $60,000, and pocket the $15,000. So when we start ignoring down payments, when we start ignoring the combined loan to value and talk just about the loan to value, not thinking about the piggyback loan, we're in trouble. And that's a lot of what we did. They used models that were based on just recent years where we had nothing but rising prices, and they misjudged the likelihood of default. One of the things we do in school, and a lot of it's business school and other schools, is we talk about these models and modeling, and it sounds so fancy, and we put together these big spreadsheets. Models are worthless without intuition, and intuition is all that matters. And what I'm talking about here is intuition. I could put together a fancy model that would dazzle anyone and make me think, okay, this is a good investment. But if you sit back and think about the intuition, it just doesn't work. A lot of these banks and bankers were so desperate to keep up their pipeline, they were buying mortgage companies. So they couldn't get their hands on enough mortgages, so we better buy the originators. They didn't recognize, or they chose to ignore, the huge changes in the market. They saw this huge increase in subprime mortgages, the huge increase in securitization, and they just kept going, and they played into it. They became over-leveraged. Banks were 10 to 1. They've sort of always been that way, 10 to 1, 11 to 1. Investment banks went to 30 to 1, right? What happens there? So you have something worth $100,000, you've got $3,000 of equity. That doesn't work. Once that price drops a little, you're underwater. You're insolvent. They also violated one of the most common things we know in finance, is that you match the loan, the terms of the loan or the terms of the capital, to the terms of the asset. In other words, when you have a long-term asset you're buying, you get long-term financing. That's why with a house, we really get a 15 or 30-year mortgage, right? I always say you buy a European car, you get a 5-year loan, right? You buy a GM, you get a 1-year loan, right? And so what a lot of these investment banks were doing was they were using overnight financing. So think about that. You buy a house and you get an overnight loan, right? And let's imagine you could do that. Well, what's going to happen is, as long as your home price stays steady or goes up, and as long as you keep your job, the next day I'll roll over your loan and I'll loan you money again for the next day or the next night. But once you lose your job, or once that price goes down of that home, I'm not going to loan the money. I'm going to say, look, you got to pay me back. Well, it's the same thing with the investment banks. They were borrowing money overnight in these short-term loans. And once we saw this risk, then no one wanted to do it anymore. And then all of a sudden, Bear Stearns and Lehman were gone. Merrill Lynch would have been gone, or would have been under severe pressure the week of September 18th if it hadn't been for Ken Lewis, who decided in one day to buy them and overpaid and drove his company into the ground. So that's the kind of thing we saw. They marketed, they sold credit default swaps. For those of you who have heard about them and not familiar with them, all that is insurance. A credit default swap says this: if you take bonds, you take $10 million worth of bonds, you can buy insurance, which will say, if these bonds default, we'll give you $10 million. And what happened was this became the largest unregulated insurance market. And what really happened was you had companies like AIG that were selling insurance. They were selling these credit default swaps to everyone, and then they couldn't pay. They couldn't post collateral in order for that insurance. And so you had these problems. These credit default swaps allowed one firm, AIG, and probably others, to create systemic risk. In other words, risk that would bring the whole system down, right? Because if AIG went under, think about what happened. If I was a pension fund and I had $10 million of GM bonds, but I had credit default swaps from AIG, they're in my books for $10 million because they're fully insured. But then all of a sudden, if that insurance goes down, I've got to write them down. I've got to write them down to 30 cents on the dollar. And all of a sudden, you've got a whole slew of problems. So that was why we bailed out AIG. Banks were ultimately greedy. They did so many things, and then all of a sudden, they had the perfect storm. They lowered covenants on bonds in a lot of the LBOs. They committed to provide LBO financing for when they hadn't sold that financing yet. They committed to provide financing to structured investment vehicles, which I'll briefly talk about. And when all these things went wrong, they owned CDOs in their own portfolio. All of a sudden, the game was over. So that was a big problem. Next, talk about the SEC. The SEC allowed investment banks to increase their leverage. One of the things the SEC did that I thought was probably the most atrocious was that after not overseeing any of these investment banks and not doing anything, they then came out with these rules during the crisis saying no short selling. I have to tell you that for years I've been telling students that if you're ever looking at investing in an emerging market, some developing country that doesn't allow short selling, don't do it. Because think about it. Short sellers bring bad news to the market. They have a financial incentive to bring bad news to the market. If you take away that financial incentive, there's no one bringing bad news to the market. Prices are set then by the average jubilant moron, right? And that's not what we want. And people say, wait a second. Short sellers spread rumors. They tell lies. And I think that's so interesting because people who buy stocks, they only tell the truth. I mean, you got to be kidding me. Well, that's what a market is. It's a place where we all meet and lie to each other, all right? It's just absolutely crazy. So we became that third world country where you couldn't sell short. And I think that really was an embarrassment to our country and to our financial markets when the SEC did that. They ultimately failed to keep up with the regulation that was needed for this financial innovation. And so that was a big problem. I'll move on to the ratings agencies. The rating agencies obviously didn't properly assess or value risk. They relied on data that was provided by bond issuers or collateralized debt obligation issuers. Their models showed that mortgages with piggyback loans were no more likely to default than just pure mortgages that didn't have piggyback loans. Well, that makes no sense. Someone who's got 20% down versus someone who has no money down, there's a big difference. They saw the volume and they didn't realize the risk, or they chose to ignore it. They didn't do due diligence, or that's what they're saying. They're saying, look, we relied on the banks. They bought into this idea that we could take all these crappy bonds or all these subprime mortgages and repackage them and make AAA bonds. Right? I mean, that's a great world. What's going on here is this is very much like in 1987. You might have heard of people who were selling puts on the S&P. Selling a put is like selling insurance, like a credit default swap. It's sort of recurring themes that we see all the time in all these debacles. But so people are selling insurance on the S&P 500, where ultimately they're making 1% each month or 2% each month, but they're saying, look, we'll make a big payment to someone if the market collapses. Well, of course, the market collapsed and they had huge problems. That's what people are doing. They're making bets against what I refer to as a low probability, high impact event. And of course, that low probability, high impact event actually happened. The rating agencies resulted in losing investor confidence in the market. There was distrust in the debt market. There was a question as to whether these rating agencies could impartially rate security. What we saw was AAA meant something different for GE than it did for a CDO. And that really never entered people's mind. One time, S&P dropped collateralized debt obligations ratings from AAA to CCC in one move. Right? And they said historically that was a 1 in 10,000 event. Well, I got to tell you that when you got some guy in California who makes $30,000 and is buying an $800,000 house, and we use that mortgage for a bond, and it goes from AAA to CCC, it's really not 1 in 10,000, right? I probably could have guessed that one. So, I'm not sure that I bought into. I'll talk more about that S&P downgrade though in a moment. Then you have these bond insurers, next party, and they provided the insurance on these bonds, which increased the demand for the securities. It enhanced the securities in the eyes of the rating agencies. Again, though, the defense for these guys is that they were risking their own capital. You know, MBIA is a great example. MBIA, what they used to do is insure municipal bonds. But then they weren't making enough money, so they started doing this, right? This was an $80 stock a couple years ago that, I don't know, last time I looked was under 5. You know, probably in the little rebound, it's come back a little bit. But you know, that's what was going on. But again, they risked their own capital. So to some extent, I blame them a little bit less. Then you've got the investors. You know, the investors relied on the rating agencies. There was a conference call where, on that downgrade that I referred to, where it went from AAA to CCC, where this hedge fund manager said, why is this happening now? And the S&P analyst who was answering questions, who was probably miserable, said, that's a good question. And the hedge fund manager said, you know, you've got to be kidding me. You need a better answer than that. And, you know, I really laugh, right, because this hedge fund manager is getting paid 2 and 20, right, 2% of assets and 20% of profits. And what, you're relying on S&P and Moody's? You know, it's a joke. You know, I always say we could get someone from DeVry Norman to do that. Anyway, the investors turned out, it turned out what they did was they overestimated the loan quality. And it's hard to forecast the loan quality when you have so little history of all these subprime loans. They thought that low unemployment was always going to protect us, and what the reality was that this was all based on increasing home prices, that subprime borrowers could refinance as long as prices went up, or they could sell their home. It protected the home market, and when that ended, it was all done. The investors didn't consider the counterparty risk. In other words, the idea that you couldn't send those mortgages back to the mortgage companies because they didn't have the capital. They also didn't think about it with credit default swaps. They thought, look, if I buy a credit default swap, I'm fully insured. Well, yeah, as long as AIG is there, and as long as Lehman is there, as long as Bear Stearns is there, you're okay. They convinced themselves, and I think like we all had, that the world had become safer, that we understood monetary policy better, and that turned out not to be true. They chased yields. They believed that arbitrage was easy. Next, you got the SIVs, the structured investment vehicles. I'll talk about them very briefly. Structured investment vehicles, what they did was they started this entity. So this SIV is just an entity. Think of it as a business, where in that business, what I'm doing is I'm buying CDOs, I'm buying bonds issued by financial companies, I'm buying mortgages, that type of thing. And so I'm buying all these securities, and where do I get the money for this? Well, I've got to finance it. Well, you know, typically to finance a business, you issue debt or you issue equity. Well, what they were doing was they were issuing commercial paper, short-term loans, right? Commercial paper is 270 days or less. Most of it's 30 days. And so you're getting a short-term loan and buying long-term assets, right? That duration mismatch that I referred to earlier. And again, think about this. This seemed like an arbitrage, right? This seemed like a situation where, look, you can borrow short-term at low rates, and then I invest in longer-term high-rate securities. That's a great deal. That's a great deal until those short-term commercial paper can't be rolled over. In other words, I'm not going to loan you money again when that 30 days is due because I see that you own these CDOs, and I see that you own bonds that were issued by Wachovia and Washington Mutual and Citi. And so then once you can't refinance, what do you have to do? You've got to sell some of those bonds you own. Well, now's not the time to be selling them. And so these guys who seem like geniuses, you know, that had this sort of arbitrage, you know, used loosely, all they were doing was they were taking this huge risk against this low probability, high impact event, which happened. So that was a problem. You know, the SIVs caused us to lose faith in the commercial paper market. And we all thought that was very safe. Then, of course, the Treasury came out with this crazy plan that they were going to take these SIVs and they were going to take the bonds, the CDOs that were in these SIVs, and they were going to separate them and put them in a separate entity, right? I mean, apparently that's going to make it better. right? So we're going to put it in this separate entity, and we're going to wait. And that's fine if there's a temporary mispricing, but there wasn't a temporary mispricing. These things were overpriced, and now they were worth less. And, of course, if you took out, and they said, well, we're only going to take out the good ones. Well, if you take out the good ones, then the SIVs are going to violate their charters, where they say, here's going to be the quality of what we own, and then they're going to fail. And so, it's funny. No kidding. I heard this plan on the radio on Bloomberg. I was driving up to actually give a speech. I was speaking to the Texas county investment officers. Every county has an investment officer, and I was giving a speech that day. And when I got there, I heard this, and it took about 10 minutes to realize this could never work. And so when I was speaking, I started talking about that, and I told people, I said, the fact that they put out this plan that could never work, or that you could tell in 5 or 10 minutes that it could never work, tells us they've got no idea what's going on, and I'm scared. And it was funny because these people who are elected officials, they looked even more scared. But of course the Treasury withdrew that plan eventually because it would have never worked. And so then you basically have the final factor. Then the final factor in all this was that home prices stopped rising. Appreciation turned to depreciation. Home prices from 2000 to 2005 rose about 11% per year, some places much higher. From mid-2006 to present, it's been decreasing about 10% per year. You saw Ohio, Michigan, and Indiana, those manufacturing states, the car states, they turned down a few months earlier. And then you saw the states like California, Florida, Arizona, Nevada that had the huge run-ups, they turned down. And, of course, they've had the 50% drops. The ones that had the biggest run-ups had the biggest drop. Existing home sales dropped, new home sales dropped, inventories increased, delinquencies increased. It started just this vicious cycle that we've been trying to stop ever since. Again, what you'll find is that the 2006 mortgages, they performed much worse than 2005, 2004, 2003, and yet the borrowers were really pretty much the same. The difference was home price appreciation was what we all relied on. And if home price appreciation hadn't continued for all these years, the people in 2002, 2003, 2004, they would have defaulted back then. So that's the situation. If you look at subprime mortgages originated in 2007, 8% defaulted within 12 months. I mean, when someone's defaulting within a year, there are a lot of things that went wrong in the system, and that's what we saw. I think the defense that people have in all this, I think there are a couple defenses. One is that some of these parties risk their own capital, so they must have been very difficult to see this in advance. And the other argument that I think people can make is that if you look at every single party involved, everyone was acting rationally to maximize their profits in the short term, right? Bankers are making their bonus in the short term, and it's hard to care about the long term. Home buyers are buying homes thinking they're going to flip them in a year or two, right? Mortgage brokers are maximizing their income in the short term, and that's what created our problems. And a lot of it, it has to come down to the fact that we have a greedy society. We all want more, and people were going out and trying to get more, and so that's my view of the world. I took about an hour and 2 minutes, so we've got a few minutes left for questioning, and I'm happy to take some questions.
Yes, I was shocked that you don't have Congress forcing the mortgage companies to lower their ratios of loans out in the suburbs and increase them in the inner city, i.e., make them fairer, but at the same time more prone to delinquencies. And then Fannie Mae and Freddie Mac going after guaranteeing all these loans and then paying their top people to millions of dollars, and that the government's not on this list.
Yeah, well, I think that the government is an issue. I'll say this though, a lot of people want to say that the laws that were designed to stop. What used to happen a lot of the and I was asked to repeat the question. Gail's going to start yelling. Where's Gail? Gail's going to start yelling at me. So the question is basically that why didn't have Congress and politicians on the list? Basically because there were laws that required lending to lower income people, that type of thing. And I'll say this, first of all, number one, I don't argue with that law personally, because we have a long history of showing that you have two people go into a bank for a loan who have the same income, same net worth. The only difference is one is a minority and one is white, and the white person got the loan and the minority didn't. We have a long history, lots of studies that show that, and there was an attempt to remedy that, and that's a problem. That's wrong. And the other thing that I actually believe that while that law caused some problems, to some extent it's a myth, and it's a political argument that people are making. And the reason it's a myth is that law did not apply to the majority of the mortgage originators, so they were not governed by that law. That law really governed the federally regulated banks, and so there's a lot of research that argues that this really wasn't the cause, but a lot of people do. A lot of this is we don't know, and we probably never will know. But that if you sort of ask my view, that's my view on it, right or wrong.
Well, I look to the government, Congress, to set up regulations, and then regulators that must enforce those regulations under penalty of law to prevent a crisis like this.
Yeah, so the question is, we look to Congress to make the laws and the regulators to regulate. There are lots of problems. First of all, the regulation was disjointed. That you have insurance companies, for instance, like AIG has all these subsidiaries that are regulated by different state agencies. You've got mortgage brokers that are regulated by the states, not nationally. You've got, if you think about the people who are doing the regulation, what happens is you go and you work at the SEC for a few years. And what do you do after you're tired of making government money? You go work for the people you were regulating. So how hard are you going to be against them? I mean, I worked for a few years for the NASD, and I got to tell you, before I went there, my father said to me, don't go there. That place is a joke. And it's self-regulation. They were regulating the brokerage industry, and self-regulation doesn't work. Putting people in charge of regulating yourself doesn't work. And I'll tell you a funny story. One time, the NASD was putting together this commission where they're going to put out some information on on all these bucket shops, because that was a big problem in the mid-'90s when I was doing this, where all the frauds. If you saw boiler rooms, sort of like that, and so it was all the senior people of the NASD and the NASDAQ, which were the two parts of NASD regulation and NASDAQ, which are two parts of the NASD. And it was all these senior people and me, and I was not a senior person at the time. And they asked me to be on this, and they said, we want you to be on it because you have a passion for protecting investors. That was what we did, right? I mean, how pathetic is it that you recognize that I have a passion, that I would stand out? I mean, that's pathetic, and what we did in there was you took people out of the industry. I mean, but you couldn't put them in the penitentiary. And so you had these people who stole $10 million, and you say, you know what? You can't steal anymore. I mean, it was a total joke. And again, it was one of those times when you realize your father was right. So the regulation just didn't work. And look, the move from for a lot of years was deregulation, and so the whole thing was, look, we're smart enough, Mr. Market will take care of everything, and obviously that didn't work. Yes.
Why did home prices suddenly start dropping?
Yeah, that's a great question. I think that I think that ultimately we ran out of buyers to some extent. But it's something that it's a good question, and the question is why did home prices stop rising or start dropping? And it's one of those things that I actually want to look at in more detail to see what do the numbers really show as to why home prices really stopped dropping. But I would say when you got up to 69% home ownership, we were still building a lot of homes, supply was increasing. And then what we saw was, manufacturing and GM and those states, those Rust Belt states getting hurt. When we saw that one start to decline and default rates start to go up, then what happened was you saw a lot of investors that said, you know what, I don't want to buy any more of these mortgage-backed securities. And once you didn't have the demand for those mortgage-backed securities, there's no more demand, there's no more ability to give those loans because you can't get rid of them. God forbid I have to hold them myself. So I think that's probably a lot of what happened. But I haven't really looked at a lot of the data on that. But that's my guess. Yes, sir.
Would you comment on the concept of marking to market, an accounting standard, which basically said as the subprimes fell and there was no buyer, the market went to, I'll exaggerate, 0, so we mark it way down, and yet the banks would say that the underlying package of mortgages, while very depressed, was not as low as you got by saying, let's go to near 0 because there's no market. Did that contribute to the problem?
The question was, did mark-to-market contribute to the problem? And the answer is, you could find, if you put 100 finance and accounting professors together, 50 would say yes and 50 would say no. I would say I'm against the argument that mark-to-market, marking securities down to their market value, was the problem. It's sort of like if I have $1 million portfolio and then the market went down 50%, and I go in for a loan and I say, look, I want a loan. They say, well, what are your assets? I say, I've got $1 million worth of stock. And they say, well, Mr. Leeds, your brokerage account says you get $500,000 worth of stock. And I say, yeah, I don't actually mark my securities to market. I paid $1 million for them. The question is, are they going to loan money to me saying, well, your securities are worth $1 million? And I would say no. And so the idea is, I think that if these, regardless of what we put these securities on the books for, it was going to be very difficult to raise more capital when people knew that they were at a loss. Now, the argument that goes the other way says, look, because of the panic, they got marked down even lower. It's hard to say, because what we really didn't know is what could they sell it for, because there ultimately was no market. And the problem was, no one knew what these securities were worth. And the fact that we've got all these smart people who don't know what the securities are worth really gets to a lot of the problem. My personal bias is it did cause a little bit of panic, but the reality was these securities were worth less, and I don't have a problem with it. But that's again, a lot of smart people would disagree. Yes.
Could you comment on some of the government solutions to the problem?
Yeah, I guess my first comment would, the question was whether I could comment on some of the government solutions. My first comment about the government solutions is that we came up with too many solutions too quickly. I think that when you start looking at putting together, for instance, an $800 billion stimulus package and how quickly we did it, the idea that this is going to help the economy, there's no question. You spend money, it's going to help the economy. But we could fly over the country and drop $800 billion out to the people, and they would spend more to help the economy. That's really what we did. It's all over the place and doesn't necessarily go towards what we need to help. There are loads of other things that I think we could do. I look at the rating agencies, which were a huge problem in this whole deal. And there's just this inherent conflict of interest. If they want to keep business, they're going to give ratings that the investment banks want. Well, what we really should do, if you're going to run a rating agency, for instance, you have to be approved by the SEC. So there's already government regulation. It's not like you and I could go start a rating agency. Well, what we should do is when you want to issue a security, you've got to register it with the SEC, and you pay a fee. That already happens. And then you go get the security rated by the rating agency, and you pay them. Well, what you should be doing is paying the SEC for the rating also, and they should farm it out to Moody's, S&P, Fitch, Duff & Phelps. Ultimately what should happen is that they should have the incentive to give a true rating rather than a biased rating. We need to separate things like that. Where we're going with a lot of this is compensation. And it's very difficult to regulate compensation because what we're going to see is all the people going to banks owned by foreign companies and that type of thing. But my point is, I think we're doing a lot of things too quickly. I think that a lot of these things wouldn't work. I've been bothered by the fact that you could look at so many of the plans that have been withdrawn. I've got a website where I write about this stuff a lot of time, and a lot of these plans came out, like the plan to buy the troubled assets, and I wrote about it, how it really didn't make sense, right? Geithner came out and said, look, all these problems were caused by too much leverage, and he basically said we're all guilty of it, and which was his way of saying, look, we're all going to pay for it, right? And then he came up with this plan that involved using money borrowed from the FDIC to buy the troubled assets. So we were going to use leverage to buy these assets to cure the problem caused by leverage. I mean, that's the kind of stuff. And I wrote about how absurd that was. And of course, they've withdrawn that plan. Just meaning, if you can see it, it's like that. It's pretty obvious. Carol's signaling time to me and starting to look violent. Let me just say, I hope you enjoy the rest of your time here. I appreciate being invited. I also say I'd love to stay around and talk. I actually have a plane that leaves at noon, so I'm going to be rushing out of here pretty quickly. But thank you very much for inviting me to be here.